How are you, folks? Enzo DiCostanzo, clinical professor, economics and finance in St. Peters, New Jersey City. And today we're doing our second macroeconomic lecture of the semester, the one for September 16th. I'm doing it on the 18th, but it was for the 16th. So let's get right to it. Okay, folks. So here we are, and I made about 140 something, 143 pages of notes. I have a couple of Jeremy Grantham's notes up here also, or papers up here from the last couple of years where he talks about bubbles. Jeremy Grantham is an asset manager who's an expert at studying bubbles, and we're going to look at a few of his graphs very quickly. How many pages? This is six. Yeah, I mean, he's got about 24 pages here. I'm gonna try to condense at some point relatively soon because the papers go back a while. Some of his papers. So we're gonna look at some of his papers and try to condense it for class. But hey, you see what's in front of you here. I mean, it can't hit you over the head any better. It says stock market is plunging, could fall a lot further, with the U.S. at the center of a huge global bubble, says chief investment officer of the world's. This is from Bridgewater, the guys up in Connecticut. That's Ray DeLeo's hedge fund. He's written a couple books. He's in his 60s, early 70s, and he started that hedge fund out of his a 2-bedroom apartment in Queens. Is what he did, and expanded to Connecticut, right? And did a tremendous thing. Didn't just walk into it or something like that. He built it from the ground up. That's a hard thing to find someone who does that. And I'm not saying that he's 100% right in every single thing he says, but certainly he's somebody worth listening to. So why is that? Why are we in bubble territory? Why can the market fall a lot further? Well, here, just very quickly, we have the week numbers that we're going to look at in a second. But the year, this means going back to the first trading day in January. The Dow Jones is down 18%. I'm sorry, the S&P is down 18%. The Dow Jones is down 15%. The Nasdaq is down 26%. The Russell 2000 is down about 20%. Over the summer or a couple summers ago, whenever it was, I did very detailed definitions of. Actually, no, it was the spring. The Dow Jones. I'll try to do that in one of these videos. We'll try to give you some very good definitions to what these indices are. But basically, it's a numerical scale that follows the valuation of the companies. As it goes up, the company's worth more. As the scale goes down, the company's worth less. And that's all. It follows earnings. The more the companies earn, the bigger the valuation. And there's two kinds of valuations. There's what the market thinks, and there's what the accountants think. With the Warren Buffett, what's the business really worth, and what's the hysteria out there valuing it at? So the folks working on the CFA activity, you're going to have a little bit of exposure to that. For the week, we had a tough week, down 4 or 5% for a week is a lot. That's not small, and I've said it in class, and I'll say it, and Mike and Pete, you guys too. And I remember this with the previous person. I won't say his name, but the previous Brooklyn guy. I remember very distinctly when I first met him. We were talking about how much these indices moved in a day. They only move about 0.5% or 0.75% plus or minus. So that's your starting point in terms of returns, in terms of what you can do with things. Okay, so if the thing moves 0.5% a day, and whatever, you do the math on 250 trading days, you're right half the time or something, it works out to about a 10 or 12% general return, 7, 8, 9, 10, 11, 12% general return on the plus side that you'd like. And certainly, as in reading through these 40 pages of notes that I made in the last 2 days or so, certainly we might be looking at a time to short some stocks. And the optimal time to do any kind of shorting is you're betting on a decline in the price of a security, betting on the decline in the valuation of a company or some sort of instrument. Probably January would have been the time to short them, but it doesn't mean you can't do it now. But like I said, there's a lot of red ink here just to keep in mind with that. Okay, so certainly the Federal Reserve is aggressively raising interest rates in an effort to cool the hottest inflation in 4 decades, but that has raised worries that it could hit the brakes too hard and slide the economy into a recession. We're not manufacturing, microprocessor chips or memory chips or communication hardware for the computer industry or the communication industry. We're dealing with people and emotions and what people want to do, and are we following the herd, which happens a lot. And certainly in New York that happens a lot. Everybody just follows what is perceived as like the best idea out there, whatever. And I want to say without doing your own analysis, but certainly hopefully people do, but that's not something you can always rely on. But I want to get back to this just very quickly because I want to look at just a couple of Jeremy Grantham's. This is the latest ones. A couple of his graphics. It's a why what we're saying here is being said. Here, this is the one I want to look at. So why it's plunging and why it could fall off further. Just very basically, and again, I know a lot of you are freshmen or don't have a hell of a lot of experience with this, but see, what says return on equity? That's an accounting term where basically it's earnings over the equity entry on the balance sheet. So it's the earnings on the income statement divided by the equity entry on the balance sheet. It's an accounting ratio, inflation volatility, how much prices move. Right now, I would call prices unstable. Again, my can of olives example, the can of olives from Belleville ShopRite, the 6-ounce can of just the ShopRite brand itself, not, the Pearl or some exotic brand of olives or some green olives from Pennsylvania, whatever my suppliers in Bellevue. I buy the green, the Manzanilla olives from Bellevue and Pennsylvania. Just the regular ShopRite 6-ounce can of olives that you put in the salad, or if you drain them and rinse them off and dry them off, right? Don't never just dump olives into your salad because there's a lot of liquid. But just a little disclaimer, the cooking advice for the day. You got to drain everything. You make a salad, it's got to be relatively dry because kind of a thing, because it ruins the salad if it's not. So price volatility and how much the GDP is fluctuating. What you want to look at the legend, and notice how this is a very similar graph to the ones we make in class. The blue line here is the realized price per earnings. This is the Shiller, where it's adjusted, like for the last 10 periods or something. But regardless of what that is, like I said, we can look that up. But Shiller has his own price per earnings ratio. There's just a standard price per earnings ratio. There's a cyclical one. But regardless of what this is a version of a price per earnings ratio. What's really happened is realized, and see what says predicted. The predicted one is down here. So this is a little expanded here. So the predicted price, in other words, what we're paying for earnings in the stock market, we predicted the pink point and we're getting the blue point. And this is way above what makes sense from an accounting perspective, a statistics perspective. Okay, that's why we're in a bubble territory. I like this example very much. Okay, but this is the Jeremy Grantham guy's situation. That's basically what that is. That's their sort of a thesis or their reasoning or their rationale why they now is Jeremy Grantham saying it? Sure. Okay, but the Bridgewater guy's saying it too. Okay, that's one example here. Let's see if I flipped through a couple of them here. This is another one. It says a 1-year change in the federal budget balance as a percentage of GDP. As the budget goes down, the subsequent 1-year change in corporate profits as a percentage of GDP's economic activity in the nation. You can see every time the budget, there's a decline in the change. In other words, the budget reduces, you have positive corporate profit expansion, positive corporate profit expansion, positive corporate. So all they're positive. Here, you increase the budget in the 60s, you have a decline in corporate profits. Okay, here in 2013, right, whatever that was, you had an increase in the federal budget, decline. Okay, here in 2020, there was just a fundamental change in the budget that it went down 11% just for a barrenness of activity. Yet again, an increase in, because you let the private industry take care of it. Now, if you look at these numbers, okay, fine. 2020 was a very unusual year, but now you have 11% increase in the 1-year change in federal budget as a balance of GDP. What is that going to do to corporate profits? We don't know. Okay, that's the problem, and that's a big positive. That's big government, and then how is that going to impact corporations, publicly held, privately held? But how's that going to impact the private sector? When the public sector has become that big, there's only so much to do in the world. If the government's taking control of it, but the government's not very efficient, it can be very biased, and it's not the ideal partner to get anything done. From painful personal experience, I can say that. Okay, it's the government is not the partner that you'll want at all in anything. These are some bubbles. This is another paper of his, so you can see after the bubble burst, it doesn't really bounce back. Housing didn't get to this. This is the 205, 206 level. the 99 2000 level. This is the dot-com bubble burst. This is just pre-Great Recession. You're not seeing a rebound in the index values of technology. You're not seeing a rebound in the index values of housing. So that's something to keep in mind. So as we're going through all the headlines, you can see there's about 12 pages of material that Jeremy Grantham is talked about. You can see some of the headings here that he talks about, and of course he goes back, uses the data that happens. Hey, what happened, and what do we think is going to happen? What do we think is going to happen? As we look back at our historical performance and then going forward, are we matching up something that happened previously? Are we seeing the same conditions present themselves again? And then what happened, whatever, in the 20s or the 70s or something, and what's going to happen in the future? I think I may have mentioned to you, I'm reading Warren Buffett's biography that was written in the 90s. So that's, how long ago was that? That's nearing 30 years ago. And something. But I have about 3 more chapters to go, and I think in chapter 20 there was a quote. Someone who knew him said, "Warren loves his history." In other words, if he did something that worked in the past, he's going to keep doing it, and he's that kind of a guy. And I'm hoping to make you guys a little bit that kind of a thinker, in a sense. Food price index. Again, I don't know why he's using the whatever company this is, the I guess United Nations Food and Agriculture Organization, but I guess that's globally where I look at the American one. But I looked at shelter indices, all these different indices that were out there, and we'll have some comments about that in the headlines as we go along. But like I said, I didn't really prepare the Jeremy Grantham stuff, but there's some good stuff out there. I'll try to post these for you guys, so you guys have Mike and Pete, I'll send these to you. But yeah, Federal Reserve, aggressive interest rate appreciation, an effort to cool inflation, the highest inflation for decades, has raised worries that it could hit the brakes too hard and slide the economy to a recession. We're concerned about that. Again, as you're now, there's 40 pages of reading here. There is some discussion about treasuries and could that be the next trouble spot, because the treasuries were where the financial markets get a lot of liquidity, and the treasuries are generally known as the backbone of liquidity for financial markets. The yield for the 2-year treasury is 3.85. Okay, so it's down a bit from the 3.92 before whatever report was being referenced, but this is certainly recently. So when the percentage decreases like that, that means there's more capital piling in. When more capital piles in, you increase the price. When you increase the price, you reduce your return. Okay, that because it's a fixed principle you're getting in fixed payments, and you're paying for those. If those someone buying those cash flows, if that's bid up, then obviously you're paying more for it. You're closer to those numbers, those sort of, you're bringing more dollars to get the same cash flows. The cash flows aren't changing because you're paying more for them. So that's why the yield reduces a little bit. The 10-year yield also fell. So in other words, people aren't confident short-term and long-term that the stock market's going to have the equity. They're not going to have a lot of returns on equity or returns in there. I don't say investment, but and really anything in the stock market is speculation. It really is. Investment is building a building, investing in trucks. The McDonald's in Belleville, they over the Great Recession 10, 12. I remember they knocked it down and built a new one. The BMW did the same thing because they figured business was going to be very low, so they took advantage. And you're not shutting your business you're not shutting down your business in a very hot commercial time. You're shutting down your business when you're probably not going to do that well, and people are just sitting around. So you took advantage, and the hit you took was a little bit less. What is it? A Fantin is like, I would say they're like a Home Depot for professionals. They're in East Orange when I drive in the morning, and there were a little garage on some little side street in East Orange, and now they're right next to 280 in East Orange, and they take off they're right next to the Amtrak railroad lines. They have a massive set up there where as I drive by at 6 or 6:30 in the morning, the parking lot's full. There's a lunch truck in there. There's so that's an investment. Buying shares of stock or even buying fixed income, that's all very speculative. Housing sector is also hurting as interest rates rise. Average long-term U.S. mortgage rates climbed above 6% for the first time since the housing crash in 2008. So we're seeing a lot of these the first time in 10 years, characterizations of the economy. The financial markets are part of the economy. Okay, I don't look at it as a separate thing. Okay, I certainly don't see it that way. The rates make a tight housing market even more expensive. Now, if you've got cash, you don't worry about this so much. But most people don't buy houses just cash. My parents did that, but most people don't do that. And again, we talked about some of the statistics here. These are some of the indices and some of the movements, the valuations of those indices. U.S. retail sales did increase last month. Is that because of price or is that because of quantity? Okay, and when with these small little movements, it's most likely a price movement as opposed to a quantity movement. If you look at the United States Department of Commerce's economic analysis website, there's quantity indexes, price indices. So it breaks it down where mathematically you take the effect of a change in quantity over a change in price. So you take a base year in terms of price, you take a base year in terms of quantity, and then you make your comparisons holding one of those constant relative to some reference year. That's basically what's happening with those. FedEx, my cousin texted me this morning. He goes, Enzo, he goes, did you see FedEx? It was down 21% or whatever during the week or whatever it was. Obviously, they're a very large logistics company, probably the biggest one there. I found a little industry description of UPS and FedEx and Amazon. It was just from a couple years ago, and it sort of ranks them. But FedEx and UPS are the two biggest ones. And FedEx does some contracting work for the United States Post Office, I think. I don't know if UPS does that, but FedEx does it. So again, it expects, and these are people, when you're in this kind of business, moving products and providing services to the public, you want to understand business conditions. You want to understand what's going on, because that's your earnings, that's your compensation, all of those kinds of things. I mean, you're very tied to how that business performs, and you want to be able to say, hey, this year, next year, 2-3 years from now, how are things going to look? Are we buying more trucks? Are we buying more airplanes? That's investment. FedEx buying more airplanes, FedEx buying more trucks, FedEx buying more facilities. There was some public service work in East Orange when I drive through from Newark into East Orange to get onto 280, and there's a big UPS warehouse in just a very sort of forgotten part of Newark, and it's substantial. It's not a small little office there. There's a lot of trucks there. There's a customer service center there. So this, again, and Warren Buffett said it long ago I think during the Great Recession, you really care about rail traffic, you really care about postal traffic and things of that nature, and how many of these on Sunday, I'm riding my bike through Essex County, you're seeing the Amazon trucks, you're seeing, and certainly Amazon is attempting to get into the business. They're attempting to get into the logistics business and into the delivery business and to all transporting products all over the place. They're trying to get into that business, and that's a business in and of itself. UPS doesn't make books, they don't write books, they don't write DVD, they don't manufacture DVD players or tools or CDs, but they move all those products around. That's what they do. So that they're a logistics business. The Federal Reserve has the worst problem in the world. A CFHR holder said this. Now, this is not Alliance Bernstein. This is something else. But he made a comment to Fortune arguing that the central bank will be forced to continue raising rates and shrinking its balance sheet, even as the economy slows, which will bring a distinct rise in unemployment. I saw something horrific. I forget what the prediction was. Someone made a prediction back to 80 and 81 where inflation was 14% and the federal funds rate was like 19% or something like that. It's in here. I didn't grab it for the summary sheets, but it's somewhere in here. We'll see if we get to it. But I know as you read through this, it's going to be there. I'm going to post this, and actually, I just want to look online for a second. Did I put So yeah, so you guys, when again the macro stuff, you sort of read it, you watch these. Okay, so I did post the note. So you want to read the note, watch the video. Okay, both of those. Okay, it's both of these are important. Like I said, folks. So, okay, we're spending. Look, you're going to go through the course. You're going to learn how to be a tax guy, right? That's more or less. It'll have a very firm beginning of that, but also learning something about the macro economy. That's for sure. And he said, continue to raise rates, shrinking the balance sheet. So again, pulling money out of the economy so there's banks can lend less. If banks lend less, you're slowing down economic activity. You're slowing down commerce. So as the economy slows, which will bring a distinct rise in unemployment, you slow down commerce. There's so much expansion. People aren't hiring. It can be further. There can even be layoffs. And actually, I found a very good discussion of financial markets and interest rates, and we'll get to that. We're not going to hit that in this video, but we're going to get to that. Investors and for investors, the hot inflation reading means stocks will continue to face pressure as rising rates increase the cost of borrowing and then lower market valuations. Okay, so increased cost of borrowing and then lowering market valuations. That's what inflation does for financial markets. Okay, there's price pressure and those kinds of things. And again, it's earnings. So if it takes FedEx more money to pay people, you're shrinking your earnings, you're shrinking your valuation. Okay, that's how inflation. And same thing with cost of borrowing. Same thing with that. If it's more expensive, you might be less likely to pursue it, to pursue some sort of debt agreement or something like that. 70% of the categories that make up the consumer price index saw annual price increases more than 4% month over month in August. And again, last year, the people who were with me last year, a few of you were with me last year. We spent a lot of time with consumer price indices and things of that nature. Okay, I didn't spend as much time going into the details of that this year, but certainly, if 7 out of 10 points there, or I'm sorry, 7 out of 10 points in terms of the categories increase month over month in August. That's got to be housing. It said, well, energy prices, and the energy price relief may not last. Gasoline prices have dropped, but again, we're hearing that's more of a demand issue than anything that the government's done or anything that the companies have done. Okay, because the prices are still so high that it's just you're along that demand curve, you're pushing less. You're pushing quantity to the left as that price goes up, because remember, the demand curve has a negative slope. So as the price increases on the y-axis, you're moving on the x-axis to the left, which is a lower Q, a lower quantity. Okay, that's I think that's really what's happening. A chief economist told Fortune he fears the rising electricity and natural gas prices this winter will end up erasing much of the savings Americans have earned from falling gas prices in recent weeks. Sure, food prices rose 11% from a year ago. This is the largest year-over-year jump since 1979 in America. Food costs are a growing concern. Again, find some article where that's referenced. Now, the full articles are in here. These are just little snippets. And this is a fund manager. It says, we continue to be optimistic that inflation will steadily decline over the next 6 months as the Fed's 15% reduction in money supply produces a very strong dollar and slows the housing sector, through dramatically higher mortgage rates. You have to be careful. A lot the asset management world, those guys love to look at the world through rose-colored glasses because they're paid to. They're paid to look at the world through rose-colored glasses. Okay, that's their job. That's their job to look at it in a very cheery, a much more cheerier way than maybe they should be looking at things. Here, Bank of America economists feel the price stability won't come until 2024. In other words, the price is moving so much, and you're having these big percentage changes in a short amount of time. Okay, and it says, like most of the peers, the Bank of America team are concerned about the rising probability of a hard landing of the U.S. economy, that we really might tip into recession. Even though I think we're in recession now, even though the employment numbers haven't caught up with it yet, but there's a lag when, and we're moving at such light speed, light speed fast pace with the interest rate changes and all the statistics that we have now. I think that things need to just sort of catch up. I certainly, if we get a third quarter of a reduced economic output, then I think the White House and the press secretary and whoever else is they're rolling up there can just say whatever and just how you can say just out and out inaccurate statements to the American people is just astonishing. The SALT hedge fund conference on this recently, whatever, is in the fall sometime, or was it the fall or the summer? I don't know. It was recent. It's probably the fall. The Bridgewater guy said stock market hasn't been fully priced in the recession yet, and the U.S. is at the center of the global bubble that is yet to burst. Okay, so that's his the Bridgewater guy. That's just the guy just below Ray DeLeo. Monday's bearish prediction wasn't the first time. Jensen spoke about his fears for the U.S. economy and the stock market. In August, the chief investment officer told Bloomberg that markets are in the midst of a deglobalization trend that forecasts that stocks will fall another 20 to 25% as the Fed continues to raise interest rates. And I have a whole economic theoretical, a good 4 pages about that. Pete and Mike, I hope you guys, I'll get you the page numbers on that, but I hope you guys will spend some time in that. Where is that? I see. This is page 2. That is more towards the end. Here it is. No, this is. I have some stuff on Berkshire Hathaway, which I'm always happy to have. Old data or someplace. Here it is. Again, this could be maybe another video, but how interest rates affect the U.S. markets. Pete, Mike, you pages 32, 33, 34, 35, 36, 37. So 32 to 37 really goes over the federal funds rate, interest rates, impact on stock market. It's a very well done 4 pages that I put together here. Discount rates, federal funds rates, and like I said, I'll go over a little bit of it, but there's a lot of detail here, and it's well done. That's very well done. Let's find. Here, this is just 2. Okay, so food prices we looked at, and what the Bank of America economists think, what the Bridgewater guys think, the comments were made up at SALT. The 1-year Treasury has been a fractional or almost zero for quite a while, and now it's up to 4%. Okay, so now obviously interest rates appreciating, right? That kind of a situation. These things have to be issued with a coupon of 4%, kind of a thing. And then the yield, generally the yield is going to be around, not exactly, but it's going to be around that number, especially for like a 1-year version of that, a 1-year Treasury. But now, obviously, if people bid these things up a lot, right, then obviously you're shrinking the yields. And again, there's a coupon percentage and there's a yield. And again, I've had videos where we've spoken about that in the past. Okay, but it was very low 2 years ago, and now it's not. And Bank of America said the following: it said, declining liquidity and the resiliency of the Treasury market arguably pose one of the greatest threats to global financial stability today, potentially worse than the housing bubble. And again, the whole financial stability idea is the financial system or the banks going to work how we intend them to work. In other words, there's going to be some event that's going to inhibit us from writing checks, getting loans, doing our banking, getting money out of the bank. Lebanon is having some enormous problem. I think someone went into a bank in Lebanon and held the manager hostage and whatever. Is a big mess because they wanted money because they needed cancer treatment for their parents or something, and they can only get a fractional amount of their deposits out. And that's when the banking system when any system starts to collapse. Like I said, we live in such an unusual, I would say an almost uncomfortable time in this country right now. That things nothing really seems to make sense. We're seeing collapses of a lot of different systems, and it's not good. I can't. So folks, my advice to the kids, you guys, my students from the school is really learn how to be useful in doing deals, and the accounting function, the legal function, the analysis function, what's going on in the economy, the bond market, valuations, how to read all of your accounting stuff, how to read the balance sheets and all the financial statements, and how to read the annual reports. Learn how to do all and that. We're doing the tax work with you guys now. So you guys will learn how to do taxes. Okay, so learn that and be useful to people who have the capital to execute the deals, and that's you'll put yourself in a good spot to do that. Treasury debt is considered a global reserve asset, just like the U.S. dollar is considered a reserve currency. This means that it's widely held by foreign central banks that need access to dollars to help facilitate international trade. A former IMF chief economist issued a harsh assessment of the economy. He said the U.S. is in a productivity recession. Wages are worse than they seem. The Fed strategy is not enough to cool inflation, as markets have not fully absorbed how much of the interest rates or how much interest rates will climb. So this is an IMF guy, a very well-educated guy. And again, you'll see his whole article as you read through these 40-something pages. So I think the Fed, they're going to hike. When it means 7, it means 0.75%, but going to talk about hiking 1%. So the federal funds rate is like 2.25% to 2.5% right now. So it'd be 3.25% to 3.5%. And this guy thinks it might be 5% in 2023. That's not that hard. That's not that fantastic of a prediction. Okay, so but he doesn't think that's enough to cool inflation to below 3.5% or 4%. Okay, so he doesn't think the 5% federal funds rate is going to be enough. So he's saying it. The Federal Reserve Bank of New York is saying, hey, we're going to keep raising interest rates. Okay, so you're getting all of these signals, right? That we're going to have increased interest rates, and then the impact of that on the economy, the impact of that on financial markets, the impact of that on housing, the impact of that on the securities and the instruments market. All right, so we're holding on to our shares, ready for this to happen. And I have the press release, the last here's the Federal Reserve's the Federal Market Committee statement. This is their press release. Spending indicators, production indicators have softened. Job gains have been robust in recent months, and unemployment rate has remained low, but inflation remains elevated, reflecting supply and demand imbalances related to the pandemic. Higher food prices, energy prices, broader price pressure. Russia's war in Ukraine is causing tremendous human and economic hardship. The war and related events are creating additional upward pressure on inflation and weighing on global economic activity. And they're telling you right here that the Federal Open Market Committee, which are the policymakers, the monetary policymakers for the Federal Reserve Bank and the Treasury, or Federal Reserve Bank, not in Treasury, Federal Reserve Bank, which is its own entity in the United States, is saying they're anticipating that ongoing increases in the target range will be appropriate. They're telling you they're going to raise. They're going to raise. They're telling you. So if they're telling you, believe them. That's my advice to you. Okay. So the committee's shown committed to inflation at 2% objective. This sounded trite a couple years ago, right? That this sounded just like a minor little thing a couple years ago. And what are we looking at? The committee's going to look at public health, labor market conditions, inflation pressures, inflation expectations, financial international developments, and everybody signs off on who was there and all those other things. So it gets very formal at the Federal Reserve Bank. So yeah, and this is Rogoff. This is Taleb. Yeah, this is the Black Swan guy, the guy who wrote the Black. He said this on Thursday. Well, hey, $7 trillion of wealth has been lost in the stock market so far this year, and there's people, I think, will say, hey, that's enough. And you're going to hear that from the asset. A banker's not going to say that. FedEx is not going to say that. But the asset manager goes, oh, everything's going to be fine. Nothing to see here. Nothing to see here. That's the asset manager world for you. So years of zero interest rates. So here, Taleb is criticized, saying he feels the economy is damaged, and this is a guy who speaks his mind. Right? He goes, you're creating bubbles, creating tumors like Bitcoin. The author of the Black Swan, the book. Now, the Black Swan is an unpredictable event that has a really bad impact, but in the third part, look in hindsight, that we could have predicted that. So a very, very unlikely event has a bad impact on society and the economies and the markets. And then the third part of that is saying, hey, that's what a black swan is. I think I have a picture of it somewhere. And Taleb has been critical of Bitcoin, comparing the cryptocurrency to a contagious disease. Again, I have people who are very bullish on that, but not everybody. Here, Warren Buffett, his companies, Berkshire Hathaway, inflation's impacting them, worker shortage, and these are very, some carpet companies and insurance companies and banking and trucking companies and rail companies, and we'll look at all of his holdings or the areas of his holding, which is better. Supply constraints, struggling consumer demand, how these are hitting American companies. And again, you want to look at the Walmarts, you want to look at what Warren Buffett has to say, and it says American companies are battling numerous headwinds, inflation, shortages of workers, shortages of material, supply chain problems, concerns about consumer spending. This is from those 5 pages on inflation or interest rates and U.S. markets. When central banks like the Federal Reserve change interest rates, it has a ripple effect of the broader economy. This is just a summary, affecting both stock and bond markets in different ways. Lowering the federal funds rate makes borrowing money cheaper. This encourages consumer and business spending, and investments can boost asset prices. Okay, in other words, because there's higher earnings, there's going to be higher valuation, then the market's going to want to pay more for those shares. Lowering interest rates also can lead to problems such as inflation, because they have too much activity, liquidity traps, which undermine the effectiveness of the low interest rates. So yeah, the whole liquidity trap situation is, again, when you don't have liquidity, or you got to make due on some kind of payment, either paying employees or interest or debt payments or something, and that's the trap that they're referencing here. Higher interest rates tend to negatively affect earnings and stock prices. Okay, so obviously, if your costs are increased, your earnings are decline. Your earnings decline, the valuation declines. The valuations decline, the price in the market declines. Okay, that's what that means. Any impact on the stock market from changing the interest rates is experienced fairly immediately. Okay, well, the rest of the economy may take a year to see any widespread impact, but also, sure, that's true, but also when down the road happens, there's also an impact. All of a sudden, we had FedEx had a bad earnings estimate or a bad earnings result or something. You're going to have another financial. It's not okay. Well, the the financial market impact of whatever interest rate happened, a year ago, a year from now, it's already priced in. That's not what that means. It's not what that means. European recession is all but assured. This is the Mohammed El-Arian said this. He's an economist. He's the president, not the Queen's College that I went to, but at Queen's College at Cambridge. And he's chief economic advisor and chairman of emerging market investments from Gramercy, which is he managed the California pension plan, and he worked for. Did he work with Bill Gross, or did him and Bill Gross have a fight or something? But I know he's a long term. He's a CFA charter holder. He's a long term guy. Europe, as far as I'm concerned, is a done deal. During Gramercy Fund's webcast for clients on Thursday, and a statement report to the Wall Street Journal. Dwindling gas supplies in Europe, soaring energy bills as a consequence of Russia's invasion of Ukraine are likely to lead to recession in the continent. Sam Druckenmiller is a guy, he's a multi-billionaire, said there's a high probability of a flat stock market for a decade, is what he thinks. That's unusual for an asset manager to say that, because of a rollback in globalization and easy monetary policy. The Fed has hiked interest rates 4 times. There's only 8 meetings a year, and they're already. And I didn't go through. Well, there's a couple more. There's September, I think, then November and December. I think something like that. I know there's at least after September. There's at least one more, maybe 2. And then billionaire investors sees a bleak outlook for the stock market. There's a hybrid. Okay, we said that already. Rubini. Robert Kiyosaki. Yeah, I try not to do the personal finance guys, quote them too much, but he was sort of folded in there. Harry Dent, I think he's an author or something, are among those predicting asset prices will plunge further. They've set out excessive valuations, stubborn inflation, potential recessions, pandemic disruptions, food and fuel crises, and some of the reasons they expect a devastating crash. And this is from the Federal Reserve's, that's from the Federal Reserve's press release. They're at 2.5 to 2.25% now, and they're anticipating going higher with that. Okay, folks, there's 40 something pages here. Okay, so please, jump into this, and even though some of the stuff repeats itself a bit, okay, but especially the here, Michael Barry. Who is this? Barry. I don't think he's a money manager. I think he's an author. Now, this is the actual article that I pulled those quotes from. Mother of all crashes. Yeah, the investor. Or he's an investor of Big Short fame. The S&P 500 chart showing the stock market index has plunged 18%. Okay, we know it's down 8%. We don't need somebody to tell us that. We know that. And could plummet another 50% over the next couple of years. Okay, and then we have Jeremy Grantham's analysis here. But I didn't pick every great highlight here. There's a lot of highlights I probably didn't. But because those first 3 pages, that's just a repeat of what's here. What Larry Summers thinks. He thinks inflation is already too high, and a severe recession may be the only remedy for high price. He worked in the Obama White House. I think he worked for the Clintons. Okay, the energy independence problem is the biggest, the biggest thing that is self-inflicted. Now, I'm not saying that what's going on in Europe is our fault, but certainly I think there's a lot of things happening that we could have managed better from a federal government point of view. And like I said, the thing I'm not going to spend a big amount of time on here, but there's the black swan. There's my black swan picture. What a black swan is. But again, spend some time. And so we'll see. Maybe we'll do a homework on this or something, where you have to discuss some of the interest rates, the interest rate impact on U.S. markets and things, where it'll just be, and maybe you make a graph of the federal funds rate and make a graph of something that's referenced in here. But there's some really good, it talks about these relationships, and you got a little bit of a summary of it here. It talks about expectations, but it's a very well done what the federal funds rate is, what the prime interest rate is, what the discount rate is. Okay, how it impacts mortgages, credit cards, other consumer and business loan rates. How those things are impacted, spending through the economy, how that's impacted, the yields on treasuries, how how certificates of deposits come into this, and just investing in the Dow Jones or something. So, but there's a lot of good stuff. Maybe we'll do another video about that. I wanted to make the summary video relatively short, folks. Thank you so much, and let's log off. folks, thank you so much. And we'll like I said, we're trying to make these videos relatively short. I think I did this in 40 minutes. So, folks, we'll see you soon. Thank you so much.